This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 17, 2026, and this is the After Hours session. Now, let's get into it. The Nasdaq Composite just fractured. Triple Q has slipped below the $710 handle to close at $705.94, while the S&P 500 holds tighter at $750.72. But the real story isn't the index level, it's the vacuum in technology. The technology sector is down 2.24%, shedding billions in valuation as Netflix crashes 11.8% to $65.59, triggering a massive rotation into consumer staples and energy. We are live on the ShadowQuant Equities edition. Before we dissect the damage, let's look at the schedule. According to our calendar, the only verified event landing today is monthly options expiration, or OPX, on July 17, 2026. That's the mechanical backdrop for today's volume. There are no fresh economic data releases or central bank announcements scheduled for this window, meaning price action is being driven entirely by corporate earnings reactions and sector rotation flows. Apex, how does this expiration context interact with the current volatility profile?
It amplifies the friction. Because there's no external macro news to distract the market, ARPX forces institutional desks to finalize hedges right in the middle of this NFLX-driven shark. The lack of competing narratives means the VIX at 15.67 isn't staying low because the market is calm. It's staying low because dealers haven't adjusted their gamma exposure yet. We're watching for a potential pinning effect in SPY around $750, but the directional bias is clearly weighted toward the downside in tech-heavy instruments.
So we have a clean slate for price discovery. Let's set the scene. As of 16:34 ET today, July 17, 2026, the broader market is painting a picture of defensive retreat. SPY is down 0.54% at $750.72. The Triple Q is taking the heavier hit at $705.94, down 1.64%. The Dow Jones Industrial Average, represented by diamonds, is holding up relatively better at $524.83, down just 0.21%. Meanwhile, the Russell 2000, IWM, is essentially flat at $295.59, down a negligible 0.6%. Pulse, walk us through the sentiment trigger here. Is this just noise, or is the NFLX move changing the mood?
It's definitely shifting the mood, but not in the way everyone expects. The NFLX gap down to $65.59, an 11.8% drop, is acting as a psychological anchor for risk-off positioning in the media and tech complex. However, look at the VIX. It's at 15.67. That is dangerously compliant. Usually, an 11% drop in a bellwether triggers a spike in implied volatility. Here, the options market is pricing in stability, while the spot market gets hammered. This creates a false sense of security for traders who might ignore the rotational warning signs. The sentiment isn't panic. It's a slow bleed of confidence in growth multiples, masked by low volatility readings.
So the crowd is still complacent. What about the broader tech sector beyond NFLX? Are we seeing similar pressure elsewhere?
Exactly. The fragmentation is key. While NFLX is crashing, you have names like Apple and Meta retaining some bullish news sentiment, but the semiconductor space is cracking. AMD is down 0.75%, INT is down 0.57%, and MU is down 0.38%, all showing bearish news sentiment. This tells me the fear is concentrated in the hardware and infrastructure layers of tech, not necessarily the software giants. It's a selective unwinding, not a system-wide meltdown. That's why the VIX isn't spiking. The pain is contained enough for the broader market to shrug, but deep enough to hurt the Triple Q.
That's a crucial distinction. Contained pain in semis vs. a massive hole in streaming/media. CIPHER, from a fundamentals standpoint, does the NFLX move justify this kind of sector-wide rotation into consumer staples and the financial sector?
It absolutely justifies it, and it highlights a fundamental re-rating. NFLX dropping 11.8% on earnings shock signals that even dominant platforms are vulnerable to subscriber growth skepticism. When the quality premium gets repriced like this, capital doesn't just sit on the sidelines, it flees to cash flow certainty. That's why consumer staples is up 2.8% and the financial sector is up 0.34%. Investors aren't buying these because they think the economy is booming. They're buying them because they're afraid the valuation multiples in the technology sector, which is down 2.24%, are unsustainable given the current rate environment. It's a flight to yield, not just a vote of no confidence in tech.
Let's dig deeper into the mechanics of this breakdown. We've established the sentiment is complacent and the fundamentals are shifting toward defensives. Now, let's look at the charts. Grid, QQQ has broken below $710. Walk us through the technical structure.
This is a structural failure for the Nasdaq. QQQ closed at $705.94, breaching the critical $710 pivot. That level it held as both psychological and recent structural support. By breaking it, QQQ is now exposing its undersides to the 10-day low support level at $700.91. To put that in perspective, QQQ is currently within 0.5% of that. There is no cushion left.
So the $700.91 level is the next critical test. Is there evidence of buyers stepping in there, or is the selling pressure overwhelming?
There is zero evidence of buyers. The break below $710 happened on a lack of absorption. If buyers were present, we would have seen wicks or reversals back above $710 during intraday swings. Instead, the close was near the lows. Furthermore, the pre-market data shows NFLX gapping down 11.8% to $65.59. That creates immediate overhead supply. Any bounce in QQQ will face heavy resistance at $710, turning that former support into new resistance. The path of least resistance right now is toward testing $700.91.
SPECTER, you often look at the risk angles that technicians might miss. Grid is talking about levels, but what's happening underneath? You mentioned earlier that the VIX is suppressing the true risk. Explain that disconnect.
Grid is right about the levels, but he's missing the strangulation. The VIX is at 15.67, which is low, but it's ignoring the macro vice grip on these stocks. Look at the 10-year, 2-year yield curve. It is flat at plus 0.41 pp, with the 10-year at 4.57% and the 2-year at 4.16%. A flat curve squeezes net interest margins for banks, but it also crushes the valuation multiples for long-duration growth assets like those in QQQ.
So, technically, QQQ is broken, and fundamentally, the yield curve is strangling growth valuations. Let's pivot to the winners. CIPHER, you highlighted consumer staples and the financial sector as beneficiaries. Is this rotation sustainable, or is it just a knee-jerk reaction to NFLX?
It's structural, not just reactive. Consumer staples is up 2.8% to $85.81, and it's up 3.14% on the week. That's consistent accumulation. Investors are moving into defensive pillars where cash flow is visible and predictable. Same with the energy sector, energy, which is up 0.92% to $57.02. These sectors are decoupling from the tech sell-off.
SPECTER, challenge that sustainability. Why shouldn't we trust the financial sector/consumer staples bid?
Because it's a crowded trade built on a mirage. The financial sector and consumer staples bids are strong because everyone else is fleeing tech. But look at the correlation break. The technology sector is down 2.24%, completely decoupling from SPY's minus 0.54%. This isn't healthy market health. It's a leadership breakdown. When the defensive sectors are rallying solely because tech is crashing, their upside is capped. Once the NFLX shock absorbs into the tape, and if the VIX remains suppressed at 15.67 for too long, we'll see a mean reversion play. Shorts in tech might cover, pushing tech back up, which would force profit-taking in consumer staples and the financial sector. The risk is that the safe havens are actually the most overbought assets in this snapshot.
Interesting. So we have a bifurcated market. Tech is getting crushed on fundamentals and technicals, while defensives are soaring on flow demand, but potentially overextended. Let's look at the small caps. IWM is flat at $295.59, down only 0.6%. Grid, does the lack of movement in the Russell 2000 suggest there's no contagion yet?
Correct, the stability in IWM at $295.59 confirms that the sell-off is highly concentrated in large-cap growth. Small caps are less sensitive to the triple Q breakdown initially. They have their own idiosyncratic risks, but don't mistake flatness for strength. IWM is down 0.6% while triple Q is down 1.64%. That means small caps are underperforming the broader index relative to their usual behavior. They're stagnating while tech bleeds. If the technology sector breakdown accelerates, IWM will likely follow, but with a delay. The current flatness is just a lagging indicator, not a safe harbor.
Apex, tie this together. We have a broken triple Q, a flat IWM, and surging consumer staples / the financial sector. What is the strategic landscape for the remainder of the day and into Monday?
The landscape is defined by forced rebalancing. Pulse noted the NFLX gap down is anchoring risk-off sentiment, but Grid correctly identified that the triple Q break below $710 removes the technical floor for growth stocks. CIPHER has shown us that capital is flowing into consumer staples and the financial sector not because those sectors are stronger fundamentally, but because the technology sector is weaker fundamentally.
So, caution is the watchword. Apex, is there anything specific you want to highlight for the close?
Yes, watch the financial sector earnings from Sure and FIP today. If they fail to justify the defensive premium, if their guidance suggests margin compression from that flat 10-year, 2-year curve, then the safe haven trade collapses. And if that happens, we won't just see tech recover, we'll see a broad-based sell-off as the only remaining bid disappears.
Let's recap the key takeaways from today's Equities edition. First, the technical structure for triple Q is broken, having fallen below $710 to close at $705.94, with the next major support level at $700.91. Second, the NFLX 11.8% drop to $65.59 is driving a sector-wide rotation, with capital flowing into consumer staples, up 2.8%, and the financial sector, up 0.34%, while the technology sector languishes at minus 2.24%. Third, the VIX at 15.67 remains dangerously suppressed despite this significant directional move, creating a potential volatility mismatch as identified by SPECTER. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.